Welcome to Market Bullets, dear investors. That's your go-to investing program designed to give you an impactful insights into the dynamic world of stock markets. In this series, we will explore a diverse range of stock market concepts employing various analysis. There will be macro, micro, and also the stock picking and crypto. So you will have all finance type of a content, so I'm very glad you decided to pop in, and at the end we'll just discover the C3 AI stock, dissecting its potential as an investment opportunity. So through a blend of fundamental and technical analysis, we'll unlock key insights about the stock. So without any further ado, we are just jumping to our first element of today. That's US economy and C3 AI stock. So that's exactly at first. Let's go through the macro economy. So right here you can find that recently we've been going through a very favorable for the stocks period, and how it right now is assessed to bring how the economy is about to assess the performance of the stock market. So risk on assets right now. So let's find out. You can find right here that I will just make the laser pointer. We can find that the pause in reducing the amount of US Treasuries on the Federal Reserve's balance sheet, coupled with a decline in mortgage-backed securities (MBS), it has created a temporary environment allowing the stock market to potentially rise without the influence of quantitative tightening. So the impact is reflected in TLT and investment, reflecting long-term US Treasury bonds, which has shown a consistent rise despite occasional declines, especially during QT periods. And you can find right here that on loans, bank loans, we are right now at the flat line. So with this November type of a period month, we are right now going through the stabilization of fiscal policy, and that is going to have a positive money flow in the banking system that may eventually increase to some extent the liquidity on the market. So even though that credit impulse in Q3, Q4 has diminished, right now we are going through another positive element, that is bank loans, that has shown a much more loosened policy that is favoring the stocks. In terms of another thing that I wanted to just point out, the current situation where the amount of money banks are required to keep in reserve hasn't changed significantly despite a substantial reduction in the Federal Reserve balance sheet. It's due to the reserve repo program absorbing the expected loss of money resulting from the asset reduction. So it has prevented an immediate impact on reserves, but right now concerns arise as the RP continues to decrease. The Fed's Treasury holdings by maturity showing, however, that we are right now in terms of 1 to 5 year notes at the negative tendency, but 10 years are rising. So it means that this discrepancy showing that the economy is somewhat resilient, but there are some concerns around the asset reduction overall, and that why those charts are starting to overlap in each other. So what the consequence it may have is that right now, at least for few months ahead, we should have a higher liquidity on the market, but right after March it may eventually fade away a little, and those undercurrents may start to reappear. So what about the golden path for the economy? the golden path, some investors are finding that it's a cutting rates. So even though many of investors are right now highly confident about the cutting rates, there will be very difficult to prove that it's a panacea that we are just waiting for that thing. So 19 weeks ago, on July 26th of 2023, the Federal Reserve implemented its last rate hike. The graph shows that there are 5 instances since 1970 when the Fed temporarily halted rate hikes for at least 18 weeks before resuming. Notably, only 2 of these cases occurred within the last 40 years. In this finding, we can find that when rates are already considered restrictive, when we are resuming rate hikes, that things that bring into the fact that rates are considered restrictive are kinda unprecedented. And the longest period during which the Fed maintained rates after the last hike before raising them again under restrictive conditions was 14 weeks ago, occurring between August and November 1988. So while there is no absolute certainty that inflation will continue its downward trend, the probability of Fed raising rates again is not ruled out. So it may even hike further. So it don't really happen very often, but still they have a mandate to do so if the economy will show some jolts. So the trucking industry, however, let's find out about this one. So trucking sector employees are laid off, and that typically in the history was a harbinger of a upcoming recession, and that's a very crucial component of the economy responsible for transporting goods and materials across various sectors. Decline in demand for trucking services may indicate a broader economic slowdown, and when businesses start to cut back on shipping and logistics, can be a sign of experiencing reducing orders and sales that may eventually inflict some problems. When it comes to, however, other data, so we are finding that still there is a room for the US stocks to grow, especially that what analysts are finding, and the financial professionals, even though are expecting 7% of return of US stocks in the 2024, investors are tilted to the positivity very highly. So investors in the United States expect to earn the highest average annual returns over the long term, with expectations set at 15.6%. This is more than double the expectations of financial advisors, and that leads us to the fact that based on such high positivity, the quintessential is to stay cautious on the way higher. So even though those new economic data may be turmoil engulfing, and we may not go through this hard recession, we may have sorry, I have just turned off the window, and we may go unscathed through those problems. Supposedly we still are overhyped, driven during this tech and AI boom that may eventually become a surprise to many investors that are not so real, I would say, not so totally grounded into this hard valuations, hard fundamentals that may lead the stocks higher. We are right now expecting the returns to be tilted higher to the upside, and even though the seven magnificents may get somewhat steadfast in the fourth quarter, it doesn't really have the implications on the grade next year. After such a great months, you can find right here that for Magnificent 7, we may have a somewhat normalization, because right now we are trading at around 36 to 40x normalized S&P 500 normalized PE, so it's absolutely crushing, and we may have a much bigger austerity in the this sector in the year to come. Right now we are jumping to Bitcoin. There is much hype around, and when people say Bitcoin is in a bubble, they mean they think its value is too high and will soon drop a lot. In finance bubbles, when the price of something goes up really fast and then crashes. Right now, however, there are many of the proponents of Bitcoin that not finding any reason to clamp down the valuation, as they expect this fourth quarter of next year to be really showing fireworks. Looking at Bitcoin, there have been a few times when its value went up a lot and went down according to this analysis. That is the fourth major Bitcoin bubble. Interestingly, these bubbles seem to happen around the same time as the halving cycle, and a pattern that occurs every 4 years in the Bitcoin world. So we are finding that the next time to come will be somewhat around 2024 fourth quarter, and even though these bubbles are bringing the diminishing returns in comparison to previous ones, still we are expecting an outstanding ROI on investments. People often talk, however, that Bitcoin might be too expensive due to its production cost. So let's find it out. Right now, electrical cost is rising, but it's following the production cost. So price right now is somewhat overlapping with production costs. So right now it's giving its miners the power to maintain the network. And right now, important factor is is to figure out how much Bitcoin is worth. If it's overlapping the production cost, we shouldn't have a bubble right as it's right now. So we still have a kind of a room to grow based on just this merely statistics. So as Bitcoin as a digital treasure is something that may entail greater attention of investors, but while production costs help us figure out if Bitcoin is undervalued, they don't tell us how much its value can go up in the future because of its digital money features. So you need to just bear on that. When it comes to other data, we can find that for Bitcoin valuations, dollar policy prudence matters, and normally when we're going through the losing of policy in quarter 4 of 2023, the Bitcoin has found its place to grow. But what will happen in the first quarter of next year, supposedly, as I said, it should be still not very bad. However, Bitcoin, as always, has constantly demonstrated that its highest acceleration to the upside is catalyzed by this M2 metrics grow. So right here we can find it. The macro indicators, even though are pushing and giving the room for this digital gold to thrive, may have its limited power ahead. In terms of Bitcoin valuation, if we just compare Bitcoin to gold, it may have a valuation of even 600k USD. So if you're just assuming and betting for Bitcoin being somewhat in the future compared to gold, it may still have around 17 times growth. So it's absolutely outstanding, but it's a matter rather not just 1 or 2 years, but rather a decade or two to come. So if the people in charge are doing things that make the regular money less valuable, like making a lot of new money through a process like quantitative easing, it may have a positive impact on Bitcoin. Would it happen this time in the next year? It will be strictly dependent on what type of economic turmoils we may have to go. So right now the economy is meandering along without a hard recession, and this environment is giving us somewhat positive but still moderate outlook for Bitcoin to grow. In terms of US liquidity proxy and Bitcoin, right here you can find the exact comparison, and this matrix shows that with liquidity, higher liquidity in the ecosystem, we are more prone to rise in the valuation of Bitcoin. So Jeremy Powell is thinking about making monetary policy more relaxed. Seeing Bitcoin's value rise a lot should make him think twice or even 3 times before making the decision, as normally the policy governors don't want to have such of a alternative currency to grow unscathed. So when it comes to alternatives to Bitcoin, obviously we have Ethereum, and right now brings back the narrative that Ethereum might be at risk of a full censorship, and what it means that many of the transactions going through the Ethereum are not fully decentralized, and a significant moment when that kind of a narrative was brought was when the US government sanctioned Tornado Cash, privacy-focused program on Ethereum, and the Treasury Department added Tornado's code to a blacklist, claiming it was used by terrorists and sanctioned groups. So it brings us to the fact that there are right now more transactions under the surveillance of government, and about 72% of data blocks on MEV Boost, a system that powers most of the validators on Ethereum, are now considered censored. So will it have a impeding effect on this Ethereum valuations in the upcoming cycle is still yet to get cleared out, but we may have a kind of a stark warning for those decentralization maximalists that are betting for Ethereum, at least for now. But right now, let's find out about C3 AI stock, and as it has been going through the earnings report recently, we need to just have an approach in what's going on to the data. So we saw unprecedented interest and traction in our generative AI offerings, said Chief Executive Thomas Siebel in latest release. Importantly, they see a return to accelerating revenue growth as we continue our transmission to a consumption-based pricing model. But does it really reflect the data right now? So we can find that revenue has maintained steady, whereas net income has dropped. So it means they cannot really take for granted its AI boom period for the economy. And even though they are talking about the stock getting through better times right now, there is still many of expectations that yet to still become a reality. So this AI narration is closely knit in the economy. But if the AI, this C3 AI stock, won't really take that chance of making the business skyrocketed through such of a favoring time, I don't expect this one to thrive any other time. So looking at the fiscal third quarter, the company anticipates 74 million to 78 million in revenue, whereas the analysts expecting 77.7, but still there is too little to face the expectations, and that's why we can find that analysts are finding the stock to trade around this level within 12 months, so it has no really room to compete with Palantir. When it comes to fundamentals, also what I wanted to point out, shares outstanding are rising, so that's negative for overall float of the stock, whereas operating cash flow, it has dwindled to the upside, but right now it backtracks. So overall, this data has brought a gloomy outlook for the company. When it comes to analysis, when it comes to tech chart, let's find out what may go us through that element and what we may expect out of the C3 AI. So I will just find out with you. Let me just jump it through. So C3 AI is today traded below this price meniscus that right now is justifying as to be a very important consolidation block, consolidation of supply. So right now, even though this demand is been found out at around $20-25, we may have a too little power to get through this other blocks within 29 and 31. However, we still have a chance that this liquidity that has been garnered around these levels may push us right to this another valuation, and then hitting this very important resistance of 33. So if we won't manage to get it through this resistance that's appearing right around 30ish, very important psychologically barrier, we may have a kind of a negativity being visible on the performance that may push the evaluation lower to 23.18. So I wouldn't really have much of a positivity right after this earnings report, and overall fundamentals are not really favoring the stock. We have sorry for the turn off, and then right after we may have a another drop to 23. This kind of a very crucial support at those levels. So right now, if you just a long-term investor of C3 AI, I wouldn't really stick with too much percentage of your portfolio to this position. Better reduce at strengths on the market. So that's it in today's episode. If you have any questions, just pop it under the video in the comments, or just let's get back to them in the chat window. Thank you very much for watching, and as always, I'm inviting you for another period to another series period to come along the way. Have a great weekend.